All right, all right. What's going on, everybody? Hey, we made it to Wednesday. It's a good start. So I was kind of just poking around, looking to see what was out there. Got so much indecision right now in the broader market, and it's on purpose. I feel bad for new traders that are starting in this environment because y'all got it rough, not understanding the manipulations that are going on in the market and the deliberate confusion that's being set out there. It's chaos. And for those of us, that see it, know what's going on, and have the patience to avoid the avoid the bullshit, we're getting along just fine. It's everybody who thinks that every day is a tradable opportunity and that they're going to come out and get something every day just because they learned how to trade. They're the ones that are getting punched in the face over and over. So if you're new to all of this and you're finding it really difficult, just trade small if you're going to trade, right? Limit your risk and exposure and realize that as you grow and as you learn, the market will still be here and it will get better because we're not going to be in this condition forever. It's a multitude of factors that put us in this situation, and they're not going to last forever either. Right? The current administration is a large part of what's happening. Doesn't matter if you like the current administration or not. They've already stated very clearly that they want the confusion, right? It's by design. They want it that way. But then there's the issue with the Fed and interest rates and inflation, and we don't have that forward guidance from the Fed. Markets are always more difficult to trade from a swing trade standpoint, right? Day trading is day trading. We'll always get, those opportunities. But from a swing trade perspective, without that forward guidance from the Fed, swing trading just hands down is harder to do. And then we have this historic change in the dominance of market cap leadership. It's happened a few times throughout history, right? When we think about railroads, well, even before that, banks and financial institutions, and then railroads, then the oil industry, and then industry itself, technology, software, and now we're getting into the destruction of software and AI becoming the newest, biggest thing. It's going to destroy the Mag 7, and who knows what the new leaders will be. Maybe they're companies that already exist. Maybe they're companies that aren't even here yet. So trying to pick who the new leaders will be is impossible. No idea. And it's going to take time for that to play out. We didn't stop having railroads dominant and swap over to oil in 6 months. We didn't do it in 6 years. It's going to take a long time for this transition, although the transitions have gotten faster over the decades and the centuries that we've been watching the market change. The distance and time between each change has gotten shorter, and then how long it takes to actually get the change on is gotten shorter. So who knows, maybe the destruction of software and this new AI dominance will happen a lot faster. But we're talking about something that generally lasts, a transition period of a decade or more. If it does happen faster, what are we looking at? 3 to 5 years, 7 years? It's still going to take a long time. So there's a lot of chaos going on out there just with those three things: the current administration, the Fed, and the destruction of software as the Mag 7 dominance. And if that's not enough, we got Japan, right? With their historical precedent just getting tossed completely out the window. They're throwing everything out and they're starting fresh, and they're going to use the same model as all the other governments in the world, that if you want to remove debt, then just get deeper in debt. Sounds pretty silly, but that's the way we do things, right? The government that we have runs that way. We run on a debt model, and their solution to paying down our debt is just to spend more and get deeper in debt. It hasn't worked for us yet, but hey, why not? So that's what Japan is doing. So that's another thing that's causing chaos and confusion out there. So you want to be very careful when you're trying to develop your swing trade opportunities. It's not just what you have on the chart, because of course we can always find some setup, some pattern, some trigger to get a trade, but that doesn't increase our success rate just because we have a good setup. It matters what regime we're in, what the market backdrop is, what the broader market breadth is doing, heck, even what the peers are doing within that group. So, for an example, if you wanted to trade airlines and you're only looking at one airline and you're not looking at any of the others, then you're just going in blind, right? Banging your head on one single tree and not realizing that you might be in a forest. Some of the best indicators you can get is other stocks. They always say that price is the best indicator. They're not lying. If the price of one stock provides insight, why not look at the peers of that stock to have even greater insight? So instead of looking at just one airline, look at five of them. Look at the ETF that represents airlines. Compare that against the market backdrop, or at least an ETF that represents the market in a backdrop, so that you would have a better idea of asking the question, how's the market doing out there? If 80% of the market is bearish and you decide you want to go long, then you're fighting 80% of the market. You're fighting a tide to try to find a long in a bearish backdrop. Or flip it around, you try to go short when everything's bullish. It's very likely your bearish trade is going to struggle, right? So the backdrop matters. We don't have a lot of answers yet on how everything is going to play out. And that's the point. It's going to take time. So if you're struggling and you're finding all of this really hard and really confusing, the things that you want to focus on are not going to change. We're still going to need to understand price action. So learning candles and candle patterns, signals that come from the candles, that's going to help you no matter what kind of trading you want to do. Having a better understanding of math, standard deviation, averages, that'll really help. Understanding the differences in the indexes, they're not all the same. Their formulas that make up the index are different, which is why the Dow stands out as being very unique with only 30 names. It's a different kind of index compared to the S&P and the Nasdaq and even the Russell. So learning more about the market will still help you, because when all of this is said and done, and it will eventually be done, as long as you survive through the chaos and come out the other side, then you'll be ahead of all of those who just wasn't able to preserve their capital and stick it out for the changes to come. What we're looking at here is the MAG 7. It's an ETF called MAGS, MAGS. On the right side is the weekly chart, and on the left is the daily chart. And you can see that we interacted with the 200-day moving average down here. It's around $61. We crossed underneath it on a gap down and then dipped even lower before we rallied up. Now we got an inside day breakout, which is continuing that drive to the upside. Looks pretty good, but we're underneath all of the moving averages and they're fanned out really nice. They're all angled to the downside. It's a very bearish signal. And if we was to count these, we've got a full trend to the downside. That's the MAG 7, right? With a full on trend to the downside. Two lower highs and two lower lows is a full set. And if you have a full set, you have a trend. And that is a very nice looking trend. We'll just use this Lenreg and snap it from the high here, drag it across, and you can clearly see the direction of this trend. Of course, if we right click on this, we can redraw it as a channel, and we can see the breakthroughs here. Reciprocation is alive and well. What we got underneath, we got on the top, and now we've done it again. So it's very likely that we could come out and cross through the top. Now, don't get me wrong, we could stall out like we did here. It doesn't owe us a transition all the way through. But if we do continue this bullish move, we've got some upside levels to focus on. One being the half of this range. So we just tag that high and this low. We need the half back of this. If we can get through that half, we've got the Linreg line. Not really a key level of resistance to worry about, except that that's also the 10-day moving average. Get through that, and we can focus on getting to the top up here. It's about 64 and a quarter. If we can break out of the top of that, then we can worry about the bigger move here. So now we've got this level, that 10, the mid of this whole thing, then the top of this range. And then I'm sure there's other levels up here that we would want to highlight, but that 50 stands out. And just getting that far, I think, would be enough work before we would need to reevaluate things. So with the MAG 7 being weak like this and getting this wealth destruction, the broader market is getting all shook up. Remember, the MAG 7 can dominate the broader market. These 7 names carried the whole of the market for over a year, all by themselves. Now, of course, the rest of the market wasn't going down at the time. They just weren't really going up, right? So it was easy for the MAG 7 to do that work easier because the rest of the market wasn't fighting against them. It just wasn't helping them out. So if the broader market wants to go up from here and the Mag 7 isn't helping and participating, it's going to be a lot harder for the broader market to do that. Now, maybe like some of the analysts have said, maybe the Mag 7 was just too overvalued, too outstretched. It got a little ahead of its skis and it needed some sort of a pullback. Maybe, right? In that case, we've had our decent pullback. We've tagged the 50-week moving average, and we should be good to go for a continuation to the upside, if that's all it is. My problem lies in this issue right here. I use a 786. Others use a 618, and we're in the middle. We overshot the 786 and went deeper than I would like, and yet we didn't go deep enough to get to the 618. It kind of implies we're not done yet. Now, that doesn't have to mean anything. We could, rally up off of the 50 and all is well, and maybe we just overshot the 786. It happens. It really does happen. So, maybe that's all it is. But I don't like it. And it leaves us in a bit of a pickle. Now, if I was to redraw this the way I generally draw things, it would actually look like that. Because I don't generally run from top to bottom when I'm using my quadrant lines, right? I generally run them up to the last run up. This wasn't the last one. This was actually us stalling out at a 111 and then failing and dropping down. When we do that, when we redraw it the way I normally would draw it, you can see we actually came down and almost tagged that 786. It's about $60. Nice big round number. It's a $10 sell off basically because we were almost at 70. And if this is done, then we've got two paths ahead of us. If this is done, we can go sideways for a considerable period of time, say for the rest of the quarter. And that's going to hold back some of the broader market. It'll definitely hold back the indexes. Maybe the rest of the market continues with this rotation that we've been seeing and everything's fine. Or we actually start to push in the Mag 7 and money comes back into the Mag 7, which means we rotate out of all the other things that's been getting money. This drives back up to the previous highs and continues its march that we've had before. And the markets finally break out of this range that we've been in for so long, and we continue that move in the in the indexes as well. We don't need to guess or assume which one it's going to be. We just need to see it play out so we know which one to trade. But even the market breadth tools and all of the different signals that are out there are left with this big question mark. The buyers aren't buying, but they're not selling. And we did see a little bit of selling, but it wasn't heavy pressure and it lightened up a lot already. So the sellers aren't out there hammering it down and the buyers aren't picking it back up. This is a big, nasty mess that we've been sitting in since mid October. And sure, I can stretch that upside a little bit. It wouldn't really matter that much. We got to get out of this box. So what I've been looking for is a bit of a wash. It's where the market gets frustrated with the lack of progress and it just dumps all sorts of stuff out on the table and then starts over. So if we break that green line, which is the 20-week moving average, then we have a chance to check this halfback. And of course, if we break that, it'll get a lot more ugly and we can come down and recheck this 650 low. The thing is, I keep looking around asking what's going to cause this problem. It can be anything, really. News headlines, right? Some war vibes, um, energy shock, GDP numbers could slip. There's just all sorts of things that could cause this. Maybe even things that aren't even on our radar right now, right? So there's this great book that I talk about a lot. It's a really old book. I've shared it in the chat multiple times. It was written by Gerald Appel, and it talks about how you don't want to fight the broader market and you don't want to fight the Fed. And he lays out things in this book in very simple terms about how if you have a SPY above the 200-day moving average and you have forward guidance from the Fed and the market isn't trying to fight the Fed, meaning you're not seeing radical changes in interest rate and bond yields, that the broader market's probably an easier place to trade. And we are above the 200, give them that. But the lack of forward guidance from the Fed has been one of the biggest issues. We're playing it ear by ear. Every FOMC meeting leads us hanging for the next FOMC meeting with no forward guidance. But when we have a autopilot in the Fed, even if we're raising rates, that autopilot provides the market with certainty about what's coming up. And then, of course, since the market's looking further down the road, their trades last longer, their participation lasts longer, trades just work better. But without that certainty, then we get the Fed getting priced in and unwound and priced in and unwound. And we haven't seen that sort of radical behavior in the last, say, 2 months. Everybody's been pretty confident about the lack of a cut. But the last time it got priced in and priced in and unwound was back here in this October, November, December timeframe. Headlines dropped us down, made people think, or the market think, that we wasn't going to get a cut. And then other data came in and they priced a cut in. So we started to rally really hard. And then down, they unwound it, and then up and then down. And it was a wild ride, right? That was just chewing people up for 3 months. And we was able to watch it in the CME tab here. And they were coming in and just hammering that thing like crazy. So when it's happening, at least you can see it. But now we're not even getting that, because we've got a little bit of forward guidance. It only carried forward for, you know, um, from December into March. It's a very small time frame, but they said they wasn't going to cut, and they didn't. And so the market, look at the certainty here, and we're not seeing that whiplash. But things are negative enough, and the president is threatening to fire this chair leader and get another one, and then that's a part of the uncertainty. Maybe it'll be June, maybe it'll be July. So that's a lot of drama, a lot of moving parts, and a real lack of sustainable direction, which makes swing trading way more difficult. So if you're struggling, just keep that in mind. It will get better. And I'm not saying you shouldn't trade. I'm not. Just that the opportunities are likely to be fewer and far between, right? And that you should not expect every single day to find really good, amazing swing trade opportunities every day, right? Because we're not in that kind of environment. And plus, that's just not how it works. Now, thankfully, because of options, we can trade everything up, down, sideways, up and down, but not sideways, down and sideways, but not up and sideways, but not down. That's a lot of choices when you think about it. It's all kinds of different ways that we can trade. And as long as you've got control of the risk and you keep that risk small, then there's no reason that you can't participate. But how small is small enough? And that has to come down to you, right? The size of your account, how much you're willing to risk. I was talking to somebody the other day and they said, "Yeah, I just have a lotto on, but I have some questions," and they wanted me to look at it. Their lotto was $1,000. Now, I don't know about you, but when I go to the gas station and I get a lottery ticket, I'm not buying $1,000 lottery ticket. That's not the size of what I would consider a lottery ticket. But it does kind of highlight the point, right? That everybody's got their own stomach for how much they're willing to risk. So Tasty Trades has a mantra of trade small, trade often. And while a lot of what Tasty promotes over the years, I have found I haven't been able to find all the sweet spots that they talk about, having just the right implied volatility and just the right cost of an options trade at just the right days to expiration. Never quite managed to find that mythical unicorn. One of the things I definitely agree with them about is the trade small, trade often concept. It's about occurrences, right? Think of an average you might have in your life, like going bowling. If you only throw the ball one time, you don't have an average. You just have an outcome. So one toss of the ball doesn't mean anything. One trade, one time does not mean anything. You can trade with probabilities and stack those probabilities on your side to give you edge. But still, one trade, one time does not define your strategy or the outcome of your strategy. It's just going to define that one single trade. So you want to lean into the probabilities, find as much edge as you can, and then run it over and over and over and over again as much as you can. That gets to be difficult if all of your trades are big, expensive, high risk trades. Remember, it's about occurrences. 10 trades a year, not enough. Not for averages. 100 trades a year, barely, barely. I'd say that it's still not enough. So we want to see 500, 900, 1800, 2500. The more numbers, the better, right? So you want to keep those trades small so that you can increase your occurrences. Well, Sophie, that's kind of the point with the lotto. The person I was talking to said that their lottery trade was $1,000 trade. So to that person, that $1,000 was small. It was the cost of a cup of coffee to this person. So I can't tell you what is small. You have to tell you what is small. But look at your account. Small should probably only represent a very small fraction of your account, percentage wise. Small should not be even 1% of your account, right? But what's the right number? I don't think there is one. But the trade should be small enough that it won't significantly impact your portfolio, right? It should be small enough that you dismiss it with a shrug and say, whatever, I don't, no worries whatsoever, right? Like dropping a quarter on the ground when you're busy and you say, screw it, it's just a quarter. I'm in a hurry. I don't care. And you just keep walking. When the trade is small enough that you can have 60, 80, 100 of them on at once and you don't care that they won't wreck you and destroy you. So you have to find a way to define small. Textbooks have tried this over the years, and I kind of disagree with those textbooks because what I found was it was actually encouraging people to overtrade size wise. So the textbooks would say, oh, don't risk more than 2% in a trade. I don't think that's the exact number, but I'm going to just pull that one out of thin air. So, okay, that doesn't sound like much, right? 2%, one trade, not a big deal. Yeah, but what if you're running in a $2.5 million account and you read that in the book and you decide, yeah, I guess I gotta keep my trades small and I'm gonna use 2% of my $2.5 million account in every single trade that I take. That's a bad idea, right? 2% of $2 million is still quite a lot of money. I don't think that would be considered a lotto. So I disagree with the book simply because I think it suggests that people should use this bare minimum standard percent value. I mean, do you really need to have every trade with $40,000 in it simply because your argument is, oh, well, I got a $2 million account. I don't know. I think 40,000 would be a bit much just for every single trade I want to put on, even if I could argue, that it's just a small percentage of my account. Now, when I started trading, I only had $300. That's it. That's all I had. And so all of those rules about not using too much of your account, I I couldn't even listen to any of them because if I did, I wouldn't have been able to trade my account at all, right? My account was just so small that I had to use a large percentage of the account just to get a trade on, and there was no way around that, right? $300 really just does not go very far at all. So don't let the rule books steer you wrong on that. One of the things that Tasty Trade is famous for is that when they put the trade on, they only manage the winners. They don't manage the losers. Now think about that. If it's losing, they just shrug and let it lose. I do not do that, right? There's all kinds of ways that we can adjust a losing trade and make it lose less or, eventually fix it and turn it into a winner. They don't even bother with the trade small, trade often logic. If it's not working, they just walk away and leave it alone. There's some logic behind that, right? Markets mean revert a lot, especially if you're trading in the indexes or in the ETFs. And so if it was going down and you're in a long, give it time. It'll probably just go up. If you go in and try to fix your loser and then you overcorrect and it starts going up, but now you fixed it. Now you're upside down, and you see what I mean? It can be a mess. By rolling a trade, you can fix losers if it's an options trade, right? Or adding to the other side. So if you're long, say in calls, then you can put on a put trade while leaving your calls alone. There's a lot of ways to reduce a losing options trade. The idea, though, is if you're going to fix an options trade, you need to know that before you put the trade on because choices have to be made, right? Take this UPS. Let's see what the market is doing here. So UPS looking pretty good, had a nice earnings, solid run up since late January. Now it's pulling back. We very likely are going to check the mid of this, right? So probably coming down into that 200 period moving average, maybe. But let's just say it's done going down. We don't get the check off of the 20 period, and now we're going to make that run up. But I'm concerned. So say I decide I'm going to take this as a long. Am I willing to fix the trade if it goes wrong? Before I get in, I need to know that answer. Because if I'm willing to fix it, I might want to get something that has more time. I might want to get something that's closer to the money or near the money. But if I don't make that decision with that idea in mind, maybe I end up trading and not having enough time, or I'm too far out of the money, and then the trade starts to lose, and I'm in a really bad spot now, and I don't have as much opportunity to fix it as I could have had. Now, when it comes to a losing options trade, you can always do something with it. The problem is how much more money do you have to risk for this solution to even be put on the table, right? So if I have a call and I paid $4.50 for it and it's losing, I could come over and grab a couple of puts, a couple, right? So now I spend $1,100 on two puts and I'll offset that risk or that loss, not the risk, the loss from the calls. But I had to now pony up another $1,100 to get that on. And by the way, both of those trades could lose. There's no guarantee that just because I'm running puts on the other side that now one will win. No, no, no. They can both lose. All I've done is significantly increased my risk. But I've also offered an opportunity to remove the loss from the calls. So we can solve options problems. That doesn't mean we should every time. So let's take your example here and ask what we might want to do with it. And is the juice worth the squeeze? For play, this is what we're looking at. It's a September 2026 option. Financials. Oh, my bad. I was reading that wrong. Picked up January 9th, 2026. It's the February 27 options. So not much time left, right? What do we know about this trade before we go anywhere else with it? It's not done with monthly options. Step one, check right off the bat. Why does that matter? It's probably illiquid. It was probably illiquid when it started, and it's even more illiquid now. Very likely, right? How do we know that? Well, because it's not on OPEX. If it was on OPEX, it would be this one. Instead, we're looking at the 27th, right? So it's not as liquid as it could be. The cost of this thing, $1.25. It has lost almost all of its value. Is it even worth closing now? No, heck no. Leave it alone, right? Don't close it because why would you? It's already lost all of its money. If you leave it alone, it could resolve itself. But what would we need? Well, it's a 56 strike call. So let's go look at the XLF. Here's the 56 strike call. No value, open interest. So you're one of the people, one of these 3,337 people that have one of these calls. Nobody's trading it because you're so far out of the money. There's just no activity here. And you're in an off expiration. So it's very likely you're going to be all alone anyways, right? Because you're not on a liquid expiry. Now, next week you will be because that'll be the week, right? Once you're in the final week, you'll start to get some participation. But right now, you don't have any. So next week, a lot of these 1,337 people are going to probably begin to resolve their trade. They're at max loss, so why close it, right? That's why nobody's closing. But next week, they're going to get too close and they're going to start to close. This thing is dead. It has no value to it. Even if you rolled it, you won't get anything for it. You'll just have time, but you can roll it. So you would want to use the roll button in that image right there where it says roll. And you would want to choose a new contract. Now you could choose to roll staying on 56. You could choose to roll farther in time. Preferably, I would recommend a monthly option, right? So we'll just look at the, I don't know, the September 18, I suppose. That's too far out. Let's look a little closer. April 17, 56 strike. That one's got a little bit of money in it. So you could roll to this one, but it's going to cost you another $35 to do that. That will prolong the life of your trade So it's not yet a loser, but you have to pony up more money. Now, you might look at that and say, well, why would I want that? It didn't go up before, or at least it didn't go up enough because your option is still losing. But it's possible, right? It's possible we could get back up there. It's only a $4 move. We have to get back through the 200-day and then the 50-day. You would only recover your money invested if the stock gets back to the upside and gets back far enough, right? If we get to 56 and get above 56, how much more would we need, right? First, you spent $125. So that would be 57.50 is what we would need to recap your original investment. Then we added another 35 on top of that. So now we would need 57.50 plus 35. That would be 57.85. We could just round that up with all of your fees and everything, and we'd say the stock needs to get to $58 by the time you close that call. As long as it does that, yes, you'll make your money back. If it doesn't do that, then no, you won't. But that's what you need. When you bought the call at 56 and you spent $1.25 on it, that gave you a break even of 57.5 right off the bat. That was your at expiration break even. That's how much money you needed to have to close that trade in profit at expiration. Considering this hasn't been up that high, right? The only way that that call was going to be profitable is if the market had made new all-time, never before seen highs by expiration. So that's one thing that you can do is roll that call. That's one way to fix it. Another way that you could fix it is by rolling it and then adding a short call, right? So you've got a 56 long. If you added, say, a 55 short, that would give you a call credit spread or a bear call spread, which always sounds really silly but whatever. It's also a short call vertical, right? It's all of those things. They all mean the same thing. Now, if you do that, what you end up with is credit, and what you need is for the stock to stay under $56. You don't want the market to go up and get above that. So it turns your bullish trade into a neutral bearish trade. Here's the 56 long. We'll sell a 55. It gives you 20 cents in credit. Well, after rolling for an additional $35, that credit isn't enough to cover your risk, right? And it won't recover the money that you've already spent, the 125. So this will just give you a little bit of money back, not enough money though, not enough. You could sell something else, say like 53. Now you're getting $1. Sell 50. There's $3. That gives you your $1.25 back. It covers the cost of rolling the call. So that 35 cents and gives you even more money on top of that. So this trade would net all of your losses and put profit in your pocket. The problem is the break even for this trade is $53. We're at 52.60 now. So if we run up another 40 cents, that trade would be at risk. BE stands for break even. But that would cover your risk, right? Just like that. So it's just an example of how we can take a loser and we can remove risk, so make the risk less than it was, or we can just completely remove a loss, but not without more risk, right? That's kind of the key to the whole thing. And nearly any options trade can be managed like this. But that doesn't mean we want to fix every loser. And this is where newer traders sometimes struggle with the logic. Sometimes it's better to lose. Nobody wants to lose. I get that. Believe me, I get it. But losing is a part of trading. And so you don't want to go way out of bounds, increasing your risk exponentially and significantly just to avoid a loss, right? But adding that short call would help. That would something like that. You can always manage an options trade. Um, but before you get into a new trade, think about that question. Am I willing to manage this one? So that and you'll pick different strikes and different expirations if you think it's going to be something you're willing to manage versus a different trade where you know in advance, yeah, no, I know I'm not going to fix this one, right? If it starts to lose, I'm just going to let it lose. I had a Pepsi call that I held for over a year, right? It was just it was a loser almost from the beginning, but it was only 20 cents, right? So $20. That was its max loss. It couldn't get any worse than that. And I got into it like way back here. In fact, I think it was the breakout of this high. So we'll just zoom in here a little bit. I got into that call when this stock broke up through that high. I went and I bought that call, right? And then, we did this loop de loop and down we went. Well, I kept waiting for it to come back, right? And I waited and I waited and I waited and it never come back. It just kept losing. But my max loss was 20 cents. I don't want to lose, but adding more money to this trade just didn't make any sense, right? And I knew that going in because, well, it was only $20 and I wasn't going to go out of my way to not lose that $20. So when you go to put on a trade, if you size it appropriately, you don't need to fix it if it starts to go wrong. And that's why spreads are such a good idea. So let's go to XLF, which, by the way, XLF, good choice. It's a good thing to trade when you're newer to trading and you're using a smaller account. And that's because this thing has $1 wide strikes and it has, relatively speaking, it's got decent liquidity. So if you are going to learn to trade options, this is a good one to choose. because this thing is so small, you have to kind of be picky about the strikes you choose. Stay on the monthlies so that you have more liquidity, right? Like the volume today, 4 digits. If we look at one of these off ones, like this one, double digits on one strike, otherwise, no volume. No volume. There's just nobody home, right? Look at this. No volume. Okay, triple digits right there. 3 digits. And right here. But otherwise, no volume. Nobody's home. So focus on the monthly. Even if you decide you don't want to trade the monthly, at least look there first because you want to look for liquidity. If it doesn't have liquidity, you're handicapping your trade and your chances of losing go up a lot right off the bat. So start with that. We got liquidity here. I'm on a monthly. It's got 30 days to expiration. And I've got 1 penny wide bid ask spread at the money. That's pretty good. Now, all of these are trash. These are bag holders. These are people who are in a losing trade just begging for somebody to come buy their option. Don't trade any of those. And we can tell because if we look at the bid and we look at the ask, first on the bid, it's all zero. And look at this hopeful fool. They've just got their order in, just resting in the books, hoping somebody will market order into it. And they'll just, I don't know, get somehow magically, they'll get it sold, which they won't. But, hopes and dreams for losing trades. So you don't want to trade any of those, which is why all of those rules that say something like trade a certain delta or a certain gamma, those don't make sense, right? To just go in and randomly choose a delta without looking at the liquidity is very likely to get you in trouble, right? Not this time because the 10 delta is like way up here, but so don't pick your strike based on the Greeks. Pick your strike based on liquidity or how far the market can move. Up here is your implied volatility average. It says that in the next 30 days, we could move $2.65. So if you was trying to buy an out of the money option, you wouldn't want to go farther than $3. So by the way, your 56 strike call, if you did have March, this says we could get to 56 by March 20th. By next week? No. We have a $1.50 move between now and the next week. Now don't get me wrong. News, headlines, something could come out and just pop us right up into 56. It's possible. But likely? No. I like to trade options that I can defend. A good trade to think about would be the financials going up to 60 or maybe even 62 by the end of the year because we've got roll. It would have a chance if you rolled it out to April. Um, April has a $3 and just call it 350. A $3.50 implied volatility measured move, expected move. So from, 53, add 3.5, that's 56.5. So in theory, we could go that far, but you'll have to spend more money to do that. Another $35 or so. So on top of the $1.25 you've already risked, you would be adding another $35 to that, which increases your max loss to 155, 160 after commissions and fees and all that. Now, before you roll, if you haven't rolled yet, don't hit the button. Hear me out for a moment. Let's talk about a poor man's covered call or a poor lady's covered call. The idea would be, suppose we're bullish for the year, long term, August, July, September, October, something like that, farther out here. In fact, let's turn on the cone. And we need lines. Aha, there we go. All right. So by August or September, we could get all the way to $60. All right. You see the 8/21 expiration here, $60. We can't trade a 61.50 at that expiration. It's going to be $1, $2, or $5. So we know that we can't do that one, but we can do 60. If you own a 60 strike call for September, that allows you to sell calls in the front end, and it's covered. You don't need, normally, if you want to sell a call, you have to have enough money in your account to cover 100 shares. In this scenario, you won't have to have that money. You'll be able to sell a covered call because you own a call, right? Which means in the front end, as long as we're not rallying and we're not, breaking above the 200 or getting above this 54 area here where we got hung up before, you can sell calls and make your money back. And then just keep on selling covered calls until that call comes to expiration. All right. So say we go to September 18 and you roll that call out to $60. You would have to pony up 65, 64 more dollars. Split the mid here, $65. But you would own this call for the next 212 days. The days that you own it matter because that's how long you have to make money in the front end. So you could sell things, and the idea here is to be nimble. You could sell it today, buy it tomorrow. You could sell it today and buy it back at the end of the week, right? You could sell it on Monday and buy it back on a Friday. You want to be as nimble as possible. So, say we roll over on this day and we start to fall and you sell a covered call. And then later in the day, we start to bounce and you buy it back. Well, you made that much. and then the next day you get to do it again. Now it costs you PDT, right? So if you're under the PDT, you might need to, sell it that day and buy it back that day, right? That sort of thing. I wish I could take credit for it. It is brilliant, but it's not mine, right? This has been around for a long time, and it's called the poor man's covered call. Where I take issue with the YouTubers out there is they will tell you to sell some far out of the money mythical call and get, like 12 cents for it. And they'll argue, oh, well, it's okay because, it's got a high win rate and blah, blah, blah. What are the shenanigans? The problem is you've got money to make up, right? You got to make the $65 back. You got to make the $125 back. Together, that's almost $200 that you need to make. And you've got 200 days to do that. So if you try nickel and diming with those far out of the money options, getting $10 here and $8 there, and then closing those early, right? You might get 10 cents credit to start the trade, but then you close it for 6 cents or you close it for 8 cents. More often than not, you'll be closing it for 4 or 5 cents. That just doesn't make it worth it. It won't work. The solution is that you want to sell things that actually have money to them. You want to get closer to the money so that the things that you sell actually have premium, right? Even if it's 50 cents, because this is a cheaper stock, right? It's a $53 stock. So if you're getting, 30 cents or 50 cents, and then you close that at 20% profit, 40% profit, at least you're netting something and you're getting ahead. So don't do what the YouTubers say. Don't go way out of the money and sell one of these 10-cent options because their argument is, oh, you don't need any technical analysis. And, looking at the delta, that'll be your win rate. So this has an 82% chance of winning, and you're getting 16 cents for it. And they'll argue, oh, that's a great deal, 16 cents, and you'll win 82% of the time, but it's a bad trade, right? Don't do that. The higher your chances of winning, the less money you'll get. That's the balance of the market. So if you wanted a 90% win rate trade, you can have it 90%, 95%, 99% if you want that. But there won't be any money there. A better balance is 55 to 60% win rate. And then you stack the odds in your favor to where you actually have like a 80% win rate, 85, but the market only sees 55 or 60. How do you cheat? Trade against resistance or support. Trade against price. So if we hit resistance of the previous day's high, previous day's low, VWAP, moving averages, Bollinger Bands, anything that you can look at and say price is restricting here or supporting here. If you see it and the market doesn't, and it's not pricing it into the options, then you're getting a higher percentage trade than the market sees. So that's your edge. This sort of trade, by the way, is one of my favorites because you can go long, say, in the Mag 7, all of them, Google, Amazon, Microsoft, the whole lot. And you can just buy January calls in all of those for next year. It's not going to be cheap, by the way. It's around $20,000 to get calls in all those for January of next year. Probably a little more than that. But once you own calls in all of those for January of next year, you can then go in and you can trade options against it. And you can pay them off. There is a handicap, by the way. So out of all of the things that make this trade awesome, here's the thing that sucks about it. Let's go back to September and talk about your 56 strike call. if you do this, this is going to be your new home. I wonder if this one strike, if that's you. I wonder. It wasn't there earlier, now it is. So here's the problem. If that is you, the only options that you can sell, that's not you? Okay, that's good. Because I want you to know what's the negative. Because there's always a negative, right? There's a good and a bad and a. So what's the negative of this? You'll only be able to sell options that are at that level or farther out of the money unless you want to add margin to the trade, right? So if you sell this, or excuse me, if you buy the 56, say you roll it out and your trade is now 56 strike for September, and you own that call, it's yours. And then you decide that you want to come in and you want to sell options in the front end, like March. The only options that you can sell without margin is going to be the same 56 strike that you have or farther out of the money. And that kind of sucks because look at all these bag holders, right? All of this is all trash. You don't want any of those. And there's no money there anyways. You wouldn't want to sell any of them. No money there or there or there. This is the only one that has even a tiny bit of money, and it's the same strike that you've already got. So you could sell that 56 and it wouldn't require any money from you, no margin or anything. But if you wanted to sell the 55, the 54, any of these, you'll have to cover the difference between your 56 and that 55 or 54, 53, whatever one of those you want to sell. It's not a massive amount of margin, but it is margin. It is going to require that you have that capital. XLF is not crazy expensive for a stock, but what if this was, some $1,800 stock? You know what I mean? Like that would be an issue for a smaller account to have to fight with. Which is why I was saying if you want to think in advance before you trade an option, like am I going to defend it or hedge it or anything like that? When I was talking about trading the Mag 7 calls, going to January and buying a bunch of calls, if you trade all of those really far out of the money and then you come back in the front, you won't have anything to worth selling, right? That would suck. So you have to trade near the money. That way, when you come in the front, you're trading near the money. And that can get expensive really fast. These aren't expensive, but we're not looking at like Tesla. $8,000 for that Tesla call. You know what I mean? Like it adds up fast. 20,000 was way too low. I should have said 100,000. To buy at the money calls in all the Mag 7, it's very likely going to cost about $100,000. Oh, by the way, speaking of those end of year kind of trades, you can go out and you can buy a put for the end of the year too. And then you can sell puts in the front end, which works really good if you're in a bullish backdrop. I know that doesn't necessarily square. Why would you want to buy a put in a bullish backdrop? But One, um, puts are cheaper when we're bullish, and two, once you own the put for the whole year, you can sell puts all year without margin. So maybe the $500 that you spend on a put, maybe you lose that. But if you can make 1800 by selling puts all year, then you'll make back the 500 you lost from the long put, and you get to make money on the short put. Plus, it's a hedge because if the market does get bad news and suddenly sells off, well, cheers for you. You're holding a put. Man, that 1 o'clock auction today flipped us over and we've just dominated the downside here. We barely paused at the halfback. We held longer on VWAP than we did that halfback today. My goodness. Very nice. We just came into the RTH Open. It's where we bounced 15 minutes ago, 20 minutes ago. See how we came down and bounced there, lifted up, and now we came back and we're breaking it. The RTH Open is a really awesome pivot. It doesn't get enough love, that's for sure. So if we get underneath the RTH Open, we're going to come down and check the low a day, and then maybe we get a breakout below that into a 111 and the 1236. Maybe. But we're holding at the moment, which is pretty awesome. It's a testament to that RTH Open pivot. There's our 5 minute open range. So mark the midpoint of that 5 minute open because if we do break down through there, you're going to want to know where the midpoint is of that bar. Look at it fight. It's trying. So it's not a bad pivot, not a bad hedge to own, right? If you was to do that in say SPY or the Qs to just go out and buy a put. It's not the best hedge in the world because your hedge is supposed to protect a certain percent of your account. One put very likely isn't going to be enough to protect any percentage. But it lets you have this long opportunity because you can go and you can sell all those puts against it, right? So how far out of the money should you go? And that's the tricky part, right? If you go too far out, like I demonstrated earlier, what you get to sell is really severely handicapped. But if you don't go very far out of the money, then you got to pony up a lot of money to buy that option. I don't hedge that way, by the way. I run a beta weighted portfolio, and I find that to be a better way to balance my risk. 688 is SPY's problem right now. That's what we got to get through. So with a beta weighted portfolio, you want to convert all of your options to SPY's options or all of your trades. They don't even have to be options trades, just all of your trades. SPY has SPY is our benchmark. So we want to ask ourselves if SPY goes down 5%, what happens to all of my trades that I'm holding? How will they benefit? Well, how we need to convert everything into apples, right? We can't have apples and oranges and bananas and grapes. because then when SPY goes down, we don't know how it will affect our trades. So we got to turn all of our trades into a SPY trade. Then we can gauge if SPY goes down, what will that do to my trade? There are some things that don't beta away, like inverse products, oil, VIX, certain commodities like oil, maybe gold, silver. Those don't beta away very well. The reason we call oil an inverse product is people don't fear oil crashing, right? They fear oil going up because the price of energy goes up, everything just gets more expensive. SPY, they fear going down, right? Because the SPY going down, the market's going down. So if you're trying to trade something that's an inverse product, it won't beta away, but otherwise it will. So you can turn all of your existing trades like SMH, Apple, Microsoft, whatever, just turn everything into SPY deltas. Depending on the platform you use, they may have a beta way selector. So on Thinkorswim in the monitor tab, it has an opportunity for you to turn on the beta weight. It's I don't trade on this, so I don't have any trades in here except some old bags. So I might need to go to paper to actually see the beta weight choice. Maybe it's over here. Activity and positions. There we go. So here it says beta weight right there. And if I had a bunch of trades that I could open up in here, then we could look at it and we can benchmark that against SPY. And it will have a beta weighted column here showing what our SPY deltas are for all of our trades. This is one way to do it. The other way to do it is on the Analyze tab. Now, I don't know, not all brokers have this, but a lot of brokers do. So we're going to put something in here. It doesn't matter what it is, just something. So I'm going to put a call in there. Get out of that. All right, so we got an option in here. We want to choose this right there and choose portfolio beta weight. Now, what it's going to do is it's going to show everything that is in here. Any trade that I might have tried to build, whether I actually put it on or not, it should be in here, right? So we'll turn on the all button here. We can see I built some Apple trades, AMC, AMD, Amazon. All these are trades that I have built. We need to look and make sure there's none in here that are expired or outdated. There's some January stuff. Where'd those go? There's some December. Those are old. Get those out of there. February 20. No, those are still good. October. Shopify. Pretty sure those are done. February 20, January. Those are done. I could just wipe them all, I guess, and start scratch, but doing it this way, I think is better. So we can leave some in there, you know. Otherwise, I'll have to add trades. June, August. Well, that's last year. Get rid of those. All right. So we've got some. Wow, that's from a couple of years ago. 2023. Clean house once in a while. That's just some stock. All right. So we've got 2025. Yeah, your Thinkorswim will run a lot faster if you come in and clean this out once in a while. I know you do. I seen that in the picture because I have Fidelity too. I just I don't really trade options at Fidelity. I mean, I have. It's just not my go-to for options trades, and certainly not my go-to for analysis. All right, I think everything I've got now is this year, and this, if we look at the top, is my current beta weight. So for what I'm holding right now, and these are all paper, right? Because they're not real trades. They're just things that I have built. You can see that I'll make money if the market goes up. I've turned all of these trades into SPY deltas, and my current delta is shown right here. I'm positive 56 delta, which we already knew I was positive delta because the curve goes up with the market. If I was going to add a new trade, which is the whole point of beta weighing, now that I know what my beta looks like, my deltas, I'm long delta, my account is not balanced. If the market goes down, I will get hurt. I don't want to add a hedge. I just want to balance my delta. So I need to get some short delta. I want my delta to be zero or as close to zero as I can get. So, how do we get some negative deltas? We could uh, sell some calls. We could buy some puts. That would give us negative deltas. Notice it's not telling me what I have to trade. It's not saying, "Hey, go buy SPY," or go trade SPY. It just says I need some short calls or some long puts to help me balance my delta and get it closer to a zero. So when I'm looking at what do I want to trade, I know that anything that I look at needs to be something that I can sell calls on or buy puts in. I don't want to add any new trades that's going to add to my delta. So let's look at FSLR. It's a semiconductor company. Sure, why not? We got earnings coming up, so I don't like that, but whatever. Well, let's try Costco. I think we're a little further away from earnings. Not much. Come on. Gotta have a little room here. Now Lucid's got earnings. AT&T. Wow. Earnings is done. So, and what the hell happened to AT&T? Okay, whatever. It's past earnings. So there you go. Right? We got this rocket ship. Oh, that means that satellite company got kicked in the face. ASTS. Oh no. Yeah, it's not that bad. That was a pairs trade. We was long this, short AT&T for a while. That trade's done. But all right, so okay, so say we wanted to use this. Short calls look good. It got way ahead of itself here. Maybe we wanted to come in and we want to sell some calls in that. So we come in and we look at AT&T and we look at some short calls. We'll just send that over to the analyzer because it will add to this, right? It'll add to what we've already got. Now, what we want to do is find that trade. There it is. And we're going to increase the size of that trade. See if it adjusts. Oh, got to be careful of that. I looked at a different market, so it changed that SPY across the top. Now we're still looking to swap this from a positive delta to at least a flat delta, right? My delta is a 55. Where'd that T trade go? Notice my deltas are going down with these short calls, and I'm just piling them all into AT&T just to get the point across. Now I've got a 48 delta. I should have chose a more expensive product. Oh, that was too many. My delta's at a 48, and if I add more short calls, my delta continues to go down, right? That's the idea. Now, I was just trying to pile them all into that one to get the curve to change, but that's not going to happen. We're going to need more products. So let's just make this 16 calls just to kind of keep things, organized. And we'll add some short Google. Now my delta is at a 25. So that one Google call was way more than 16 AT&T calls. There you go. My delta is now barely negative, -3 delta. But look at my curve. So if the market goes up, I'll make money. If the market goes down, I'll make money until we cross this curve here. And then I'll start to lose money if SPY gets below, let's call it $200. Does anybody think SPY is even going to go to $200, let alone get below it? I don't. But I mean, nuclear war, anything's possible. If SPY fell far enough, then I would begin to lose money if SPY got below $200. That is the beauty of beta weighing a portfolio, that I can look at what I'm holding, look at my risk against SPY, and then ask for my new trade, whatever it is that I'm about to add, what do I need? Positive deltas or negative deltas? And then that's what I go in and I choose to trade. And I can do it in, AT&T, Google, it doesn't matter. I just need to get some positive deltas or some negative deltas. This helps me keep my portfolio balanced as much as possible. And I don't get too heavy on one side or the other. Otherwise, the danger is, especially for new traders, say you've got an Apple and Microsoft and Google and the Qs and Tesla and Nvidia, and you're thinking, yeah, I've got a lot of trades on. I'm spreading it all out, baby. I'm diversified. But really, you're not. Those are all the same trade. And if you went long in all of those and we go down, you're going to lose. If you went short in all of those and we go up, you're going to lose. Unfortunately, if you went long in some and short in some in that same basket, you're going to lose, because they're all going to do the same thing. And if you went long in Apple and short in Microsoft, one of those is going to lose. It's called a forced error, and you're locking in a loss by forcing one of your trades to win for the other one to lose. But with this beta weight, setting all that argument aside, this beta weight will help you look at what your aggregate SPY delta is, and then help you answer the question, if I go to add a new trade, should I get some short deltas or should I get some long deltas? If you don't have a broker that does this and you want to bait away your portfolio anyways, you can kind of do it, but you're going to hate it. My recommendation would be to get a broker, even if you're just using, like I use I use TD Ameritrade for analysis only. I do not trade here. You know what I mean? I don't want to trade here, but I do all my analysis here. Do that. Get a broker that you can use for analysis and bait away with it, even if you have no intentions of ever trading with it. The alternative, if you still want to bait away your portfolio and your broker doesn't let you do that, is you manually tally all of your deltas. Yeah, sucks, doesn't it? So here's how you do it. Find your trade. I'm going to randomly pick one of these. This Walmart trade right here. This will be complicated enough to let's do a single so we're not so complicated. There we go. One, just one. Just one. Single. Got one right there. This Apple call right there. This April 17 285 call for Apple. What's the delta of that one trade? To find that out, we go to Apple. That's the 285 for April. 285 April. That 285 Apple call has a delta of 24. So in my spreadsheet, I would write down 24. If you have stock, it's 100 delta. Or in the 1.0 delta, right? That's each share is 1.0 delta. So that when you add it all up, you can tally it, right? Puts are negative. So over here, if we had that 285 as a put instead of a call, we would just look this way instead of that way. And we'd say, hey, I've got a negative 78 delta. That is a minus sign. I know it's probably hard to see in the stream, but there is a negative there. And you can manually tally all of your delta that way. And it moves. So you'll have to constantly do it. Like every day, you'd have to go in and manually calculate what's my delta now. That's why I said you'll hate it. It kind of sucks. Yes, you would have to build your trades in Thinkorswim if you're not using Thinkorswim to hold those trades. But once it's built, like you can see in the Analyze tab, I got all those trades. Once it's built, you don't have to build it every day. You can just leave them in there until you're done with them and then close it out, which is nice, right? Because then you don't have to worry about every day having to rebuild that. If you've got Tasty, it already does it for you, and that's nice. Like on Thinkorswim, if you use this for a broker, you can look at your beta weight in the monitor tab under activity and positions. And that's okay. I mean, don't get me wrong, that's nice. But if you don't trade here and you just want to use it to analyze your positions, then you can build them all in the Analyze tab. And if you build your trade portfolio in Thinkorswim and you don't get anything showing up here, turn things off one at a time until it finally shows up. And that's because there might be something that you're holding that doesn't beta away, like crude or VIX, gold, silver. Maybe the gold or silver beta weights, maybe not. It just depends on what you have. But those can be a problem for beta waves. And it might be why you're not getting some answer up there. Also, make sure that it stays on SPY. Because if you change what you're looking at, say I come in here and I put this on Google, and then I come back over here, it's very likely that it changes that to Google. And then you think you're beta weighing with a benchmark against SPY, but you're really benchmarking against Google. Some modern analysts don't actually use SPY as a benchmark either. They use the Qs, which is kind of cool. If you think about it, a lot of us trade more technology stocks than anything else. So if you're finding that most of your trades are technology stocks or are in the NASDAQ, why not just benchmark against the NASDAQ? That's, it's a good way to get things done. It really doesn't matter because all we're trying to answer is what's my aggregate risk if the market does go up or goes down. All right. And that's kind of the whole idea. The problem with hedging is, say I've got $70,000 of trades on between stocks and options and just a combination of things. And now I need to protect that 70,000 of trades. Well, I'm going to need more capital because I have to go out and buy stuff, whether I'm buying VIX calls or SPY puts or something, but I'm going to need more capital. How much more capital do I need to protect the 70,000 in trades that I've already got on? Usually, it's not enough, right? Like you need to set aside X amount of capital at all times and be ready to deploy it for protection. And inevitably, the protection gets very expensive as soon as we sell off even a little bit, right? This was not much of a sell off, but puts went up quite a bit and VIX went up very, very much too. So if we don't get hedges until, quote, we need them, by the time we get them, they're so crazy expensive that we can't get enough, right? What's the alternative? That we're buying hedges when we don't need them. And that sucks. Throughout history, what we've realized out of market participants is they'll hedge when we're doing this. And then when we start doing this, they get tired of carrying those hedges because it's weighing down their profit, right? They're not getting returns that they want because they have to keep paying for these hedges for no reason. And eventually they close those hedges and they don't open new ones. And then they're running without hedges. And then, of course, eventually we flip over and go the other way. And then they're scrambling to get hedges again. Every year, it seems like every year, some big fund blows up because they weren't running protection and they got caught sideways in some volatility spike or oil spike or nat gas spike, and it blows them completely out of the water. And in the interview, they'll say, yeah, we was hedged, but we went 6 months without uh, any need of a hedge, and we just thought we could maximize our returns if we quit using the hedge. And then they didn't have one when they needed it. So I don't like using hedges. Plus, you never quite know how much you need to hedge. Yeah, that's another good way to hedge is SQQQ. Yep, that's another one that people use. But it's kind of the same argument, right? By the time people go to get it, it's already run up quite a bit and it's ready to mean revert and fall back down the other direction. So then they're buying into it when it's already at the highs and then it's falling and they don't get to maximize the opportunity from the hedge. Getting a hedge after the market has already started in the fall is, I hate the old analogy, but it's like shutting the barn door after the horse got out. It's kind of too late at that point, you know? But the analogy does fit. So here's sort of the problem. If I've got 100,000, well, let's stick with that 70. I've got 70,000 in trades. If SPY drops, I don't know, 5%, how much is that $70,000 account going to lose? And remember, it's diversified with a bunch of stuff, stocks, options, spread out into all kinds of things. If SPY goes down 5%, how much am I going to lose in that $70,000 account? We have to be able to answer that question to even start to get the hedge on. So if I think that this $70,000 worth of trades could lose 15,000, so my risk right now is $15,000. I need to go out and get some sort of trade that will make money up to $15,000 or more in a fall with SPY. Now, to be able to answer that, I got to figure out, well, how far do I think the market's going to fall? Are we going to fall 3%, 5%? Because if I need 15,000, but the market's only going to fall 2%, I'm going to have to get a lot more puts. But if I need 15,000 and I think the market's going to fall 10%, well, I don't need as many puts. Less puts will make me more money just simply because we're going to fall a long way. You see how complicated it gets trying to protect a portfolio that already has existing trades on? There's a lot left to be answered before we can go out and get hedges. Otherwise, we're just shooting in the dark. We have no idea how much we need. We don't know how much we need to buy or what our risk is. And then we can get too much hedge, and then the hedge itself becomes risk. So hedging is really tricky. And what I noticed with retail is they'll say, I'm going to put on a hedge. But what they really mean is, I'm just going to put on a short trade that'll make me money if the market goes down. Those are not the same things. So if you're just going to put on a trade because you think the market's going to go down, just call it a short trade because that's what you're doing. You're just putting on a short trade. You're not hedging a damn thing. The only way it would be a hedge is if you ran the math and did the calculations and determined how much risk you have, how much risk you need, and then you're going out and acquiring to close that gap. That is a hedge. Otherwise, you're just trading a short trade. It doesn't mean that we can't call it a hedge, anyways. I see people using the wrong terms all the time. I've been told that I use the wrong terms all the time. So, tomato, chicken and egg, we can call it whatever we want. Just, in your mind, just remember it's not a hedge if you're just going short. It's just a short. It does help if you doctor up your charts, if you're trading options and you're trying to get better at options, I found that this was really helpful when I was getting better at trading options. It to doctor up your chart. So I got Google here. Say I want to go long, and I'm going to sell some puts, and I'm going to carry that trade. So we'll just come in here and grab these April puts. My goodness, what is that? There we go. So what we've got here is our break even line. Price needs to be above that level at expiration. Now, since I just sold some puts, I don't really have a particular price target to aim for, but what we could do is mark the options out on the chart. So I got the 300 and the 290. If you're only carrying one trade at a time and you close one before you open another, this may be a little bit of overkill. Maybe I don't think it would be, but it might. But if you're carrying a lot of trades and you're going to have them for a while, this gets to be really helpful really fast. The idea is that you can be flipping through your charts and you can see at a glance how your trade is doing. You don't have to go into your account portfolio and dig through all the numbers and squint at all those values. You can just look at the chart and be like, "Oh yeah. Oh yeah, yeah, yeah. I got a long trade here and it needs to stay above that white line, that break even, which we obviously are. So I guess I'm good." And you could just move on, right? You just go on to your next trade or flip through your charts. You don't have to do anything. And you if you forgot what you were in, you can still just look at it and be like, well, that's my break even. I'm good. We're not at risk. And oh, I hate getting stuck in a trade. All right, so you've got a 108 call for Feb 20. Wow, you went way out of the money. Yeah, see that kind of shows exactly what we were talking about. So the problem with this is the bid. There's nothing out here. There's no volume. There's nobody bidding on it. Nobody's trying to bid on it. And that profit isn't real. And in 2 days, this option will be zero. It won't have any value to it whatsoever. And there's really not a damn thing you can do because you won't fill it to even get a roll. If you wanted to roll, you wouldn't be able to roll it. Look at all those bag holders. My goodness. So it looks like you paid 5 pennies for it. Your best bet would be to try to get 7 pennies for it or 10, right? I know it says 57, but you're not going to get, I know it says 79, but you're not going to get 79 for it. But you might get a broker willing to close that trade out just to get it closed, maybe. But you can see all these. So what I would do if I wanted to get out of that is I would start at 75 and then I'd start knocking it down a penny, submit the order, or a nickel, submit the order, wait 2 or 3 minutes, knock it down another nickel, submit the order again, wait a couple minutes, do it again. That's called working the order. And I would keep working the order until I got down near my original cost. And then I just stop there and wait to try again tomorrow. But all of these bag holders are going to get zero by Friday at the close. This goes back to the probability of profit. See the delta? Since you're long an option, the delta is your probability of it being in the money at expiration. And right now, there is a 0 chance that it'll be in the money at expiration. There's a 1% chance that the 86, 7, 8, and 9 will be in the money. A 1% chance. So all of these are already considered a max loss by the broker. Yeah, that's a fidelity issue. Not really, but I mean, it's a broker issue. When you first pulled up the account and said you wanted to try to manage the trade, it basically locked in that price. So you'd have to exit the entire thing and then open it back up again and try a different price. It's kind of silly, but it's just the way Fidelity is. One more reason that I don't like to trade options there, but even the stock does that at Fidelity. So for anybody watching the replay, this is what we're talking about. It's this message here. And right now the ask is 79 and it's not letting you go below 79. That sucks. They're basically locking you in to a loser. Yep. Because it's already so far out of the money as far as they're concerned. There is no way you're going to make anything for it because it's showing a 0-0, right? Goose eggs. And see, the ask can be set by any one of these 12 market participants. Somebody in the group is offering 79 cents. And until that person takes their trade off none of the other participants in there are allowed to submit an order for less than that current asking price. That sucks. That's Fidelity. But the trade's not worth 79 cents. So that's the thing. It's not. It's not worth 79 cents. The last contract that was traded closed at 9 cents. If you were going to approximate the value of the trade right now, that's your best representation of price. And even that isn't a fair representation because we don't know when that trade took place. It may have happened yesterday, last week. It didn't happen today because there's been no volume today, but we don't know when that happened, right? So that's at least the last is a fair representation of value. If I owned one of those, in fact, you can do this. You can try to submit that as a sell order and set it at, I don't know, 85 cents. Don't go up to like a dollar something because then Fidelity's going to give you an error and say you're reaching too far. But I think you might be able to put an order in for like 85 cents and we would all see this number change. And of course, you're not going to feel for 85 cents any more than this person is going to feel for 79 cents. But it's the point, right? Is that when you trade an illiquid product, one person can set the ask, and then anybody else looking at that might think, oh, wow, it's worth $79. Nope, it's not. That's just what somebody wants for it. So how do we do? How did the market close today? We're still in that range for the week. We're tagging the midpoint of this boss bar. For the day, we kept our inside day breakout. That's good. And sure, we gave up something in the middle of the day today, but we didn't close below our own midpoint, and that's really good. This is our current leg. That's the midpoint of that current leg. Nice double bottom down here. Actually, it's more like an inverse cup than a double bottom because a double bottom's a bear trap, and this didn't trap any bears. So from our own low to our own high, we closed above the mid. That's a good start. This market is just so janky and broken. Look at that. We came down and we got into that RTH open, and we never got deeper than that. You got to love that RTH open, man. It's a heck of a pivot. Walmart. Hey, when you guys are doing your own morning briefing in the mornings, keep your eye on Walmart because that stock is a bellwether for a lot of the economy. there are some companies that are worth watching and some CEOs that are worth tracking. So Walmart's one of those companies. I was looking at, I could have swore in the morning briefing material, I wrote about Walmart. Yeah, there it is. It's one of the largest retailers, one of the largest companies by revenue with over 2 million employees globally. So it's not necessarily, Walmart did good or Walmart did bad, because that's one small piece. What you want to listen to in the report, or just wait for them to report and then get it afterwards and read it. What you want to focus on is their forward guidance, because they spend a lot of money to try to determine how much buying they're going to see from their clients, right? From consumers. So when people who work at Walmart run the numbers and look at the spending trends, they will report that in their earnings and they'll say, we see spending increasing or we see spending slowing down over the next quarter, blah, blah, blah. And that will have a real immediate impact on stock prices tomorrow. If their forward outlook says that spending is drying up and people are becoming more frugal and they're not, getting big ticket items, they're not shopping as much. So, how often they shop and how much they buy when they shop, those metrics, ooh, that's a big one. So, keep track of this earnings because it matters. So, we'll see how it goes. Otherwise, let's wrap it up. I think on Friday we're going to look at some back testing of mechanical trades. Mechanical trades are a good way to deal with markets that are in this condition. Yeah, it is kind of. Um, Let me just pull that over here real quick. No, no, that's all right. I know what you was looking for. Steps to the morning briefing. It should be right there. It should. If it's not, then it's here in the trade blogs, right? Because that's where we was at when that's the blogs right here. So when you go to the blogs, just scroll over to the one that says morning briefing. So mechanical trades are a good way to deal with the current market that we're in, this lack of forward guidance and, the interest rates and FOMC and just all of the drama and the chaos. It's not a perfect solution, but it will offer you opportunities because they're mechanical. You don't have to, get the right signal at the right time, and none of that stuff even applies. It's just if A, then B, and you can set it up in advance, and it's just really awesome. So we're going to talk back testing on Friday. I have a site that allows me to do that a lot easier. You don't need the site, it's not free, but you don't need it, is the main thing. I use it so I can get, really good answers, but you can do it without. But we're going to dig into that Friday and talk mechanical trades and the opportunities that are out there that doesn't require technical analysis, timing the trade patterns, trade signals. You don't need any of it. It's always nice to have, but you don't need it. So that's what I got for you guys. Let's wrap it up. I will see you all in the morning.